On that note, I'd like to jump in just quickly to update some stuff on the car market, because I mentioned it and I talked about it in the last one about the luxury car market.
Okay.
This is something that I've kind of learned about because I've been digging into it further, and it's not just simply because people are less apt to spend and that's what's causing the car market to slow down. And this is the same with the watches and luxury goods segment. The luxury car market and like the G-Wagon's a prime example. Those prices were so inflated. What was happening is there's a market behind the scenes between all the dealerships. So you have the producer Mercedes, you have the dealers, which is actually Mercedes dealerships, as well as exotics and used car dealerships and all that. And then you have the actual baseline consumer. And I'd say there was more G-Wagons or more luxury cars trading their hands with the dealers, and they were wanting to stockpile them as a hedge. They were basically investing within these cars because what happened is, okay, Mercedes...
Especially when they had no new inventory.
Exactly.
Yeah.
All these companies, whether it be tech, luxury goods, vehicles, were all saying, we're not going to be able to produce at the numbers we want. So that's going to force up the values of these things. Yeah. So people started stockpiling. So dealerships started stockpiling, which caused this inventory crisis. And they would sell one at this marked up price. And that was a proof of concept. They'd be like, well, look, we just sold an F-150 for $120,000 or a Bronco for $50,000 over sticker or a G-Wagon for $100,000 over sticker. And so then that justified them going to auction and buying a bunch of them. Overpriced, but the auction was just between two dealers, and so the dealers were holding all this inventory and holding the bag, and they were artificially creating this value bump. The second rates went up, and then the dealers now have to sell because the rates went up, and they buy on lines of credit. So now they were trying to start to dump some of their inventory, and the second they all started trying to dump at the same time, the values started coming way down because there never really were consumers. There was the odd person buying these cars at these $50,000, $100,000 markups.
But it's low sample size.
But it was low sample size, and they were never consuming as much as actually what was going on. And so dealers were sucking up all the inventory, and it was a back end thing going on. So I want to just mention that because if you guys listened to the last one where I talked about luxury goods market and kind of why I thought the market was falling apart, I've been digging into it more, and I'm starting to find out this is what's going on. Watches were a big thing as well. Watch dealers, like, that's half of the game. That's where they make a lot of their money, is trading between themselves. Is they're ordering 15 from Rolex, and then they're getting them, and then they're selling them off to a bunch of dealers that are smaller that can't get their hands on them, and they're marking them up, and those dealers are stockpiling them because they're investing in it. Like it's a funny game that goes on, but anyways, long story short,
I mean, it gets a little pyramidy, and then things start to collapse down.
So that was an update I want to make because I talked about the cars. But going back to what you said,
when I was broke, I had rich habits. When I was broke, I had rich habits.